Have you ever wondered why some of the biggest opportunities in history appeared just before the crowd realized what was happening? What if the silver market is standing at one of those moments right now? While most investors remain focused on stocks, artificial intelligence, and the next Federal Reserve meeting, some of the most respected voices in the precious metals industry believe something extraordinary is beginning to unfold. David Morgan has spent decades studying silver, and today his message is stronger than it has been in years. He believes the long era of silver price suppression may finally be approaching its end. If that happens, the impact on silver miners, physical silver, and the entire precious metals market could be enormous. Stay with me, because the evidence building behind this story may completely change the way you look at silver. Silver has always been one of the most misunderstood assets in the financial world. Unlike gold, silver sits at the intersection of investment demand and industrial demand. It is a monetary metal. It is an industrial metal. It is a strategic resource used in modern technology. Very few assets play all three roles at the same time. That unique combination is exactly why silver often moves differently than investors expect. For years, many silver investors have argued that the market has not reflected the true value of the metal. Some believe paper trading has dominated physical demand. Others point toward futures markets where massive trading volumes often exceed the amount of physical silver available. This debate has continued for decades. Now that conversation is becoming louder again. David Morgan recently explained that the balance between physical supply and real-world demand appears to be changing. His argument is not based on emotion. It is based on mathematics. It is based on industrial consumption. It is based on mining production. And it is based on inventory trends that professional investors have been monitoring very closely. The idea of silver price suppression has always divided the investment community. Critics argue that the market simply reflects supply and demand. Supporters believe paper contracts have distorted prices for many years. Regardless of where someone stands in that debate, one fact is becoming increasingly difficult to ignore. Physical silver demand continues growing while new mine supply struggles to keep pace. That imbalance matters. Global demand for silver has expanded because the world is changing. Solar energy continues breaking installation records. Electric vehicles require more silver than traditional vehicles. Artificial intelligence has triggered massive investment in advanced semiconductor manufacturing and data centers. Medical technology continues relying on silver because of its exceptional conductivity and natural antibacterial properties. Consumer electronics remain another important source of demand. Every smartphone, every laptop, every advanced communication system, every renewable energy project, all depend on silver in some way. Unlike many commodities, silver is consumed. A large percentage of industrial silver cannot be recovered economically after it is used. That means much of the silver mined each year permanently leaves the investment market. This creates a challenge. Demand continues increasing. Available supply does not increase at the same pace. Mining companies cannot simply double production overnight. Opening a new silver mine often requires years of exploration, environmental approvals, infrastructure development, financing, construction, and workforce expansion. Even after prices rise significantly, production usually responds very slowly. That delay creates the possibility of future supply shortages. Several industry reports have already pointed toward consecutive years of structural silver deficits. In simple terms, the world has been using more silver than it has been producing. Inventories have helped bridge the gap. But inventories are not unlimited. Eventually, markets begin asking an important question. What happens when available stockpiles become much smaller? That question sits at the center of David Morgan's latest warning. He believes investors are beginning to recognize that silver is not simply another commodity. It is becoming increasingly strategic. Governments want renewable energy. Technology companies need advanced electronics. Military applications require highly conductive materials. Artificial intelligence infrastructure demands enormous amounts of sophisticated hardware. Silver remains essential for all of them. This combination of monetary value and industrial necessity creates an investment profile unlike almost anything else. Another important factor involves central banks. Although central banks mainly purchase gold rather than silver, their record buying activity sends a broader message. Official institutions continue showing concern about long-term currency stability. When central banks aggressively accumulate hard assets, investors often begin paying closer attention to precious metals as a whole. Silver frequently benefits from that shift in sentiment. Inflation expectations continue influencing the outlook as well. Although inflation has moderated compared with previous highs, many investors remain uncertain about the long-term purchasing power of fiat currencies. Government debt continues expanding, budget deficits remain elevated, interest payments consume larger portions of government spending. These structural challenges encourage many investors to diversify into tangible assets. Silver often becomes part of that conversation. The Federal Reserve also remains a critical variable. Interest rates influence bond yields. Bond yields influence the U.S. dollar. The dollar influences precious metals. Whenever markets begin expecting lower interest rates, silver often receives additional support. Even before the Federal Reserve officially changes policy, investors usually reposition their portfolios based on expectations. That process may already be underway. Economic growth has also become less predictable. Manufacturing data continues sending mixed signals. Consumer spending remains uneven. Housing markets still face pressure from higher borrowing costs. Employment data occasionally surprises both economists and investors. Every new report has the potential to reshape expectations about future monetary policy. Silver reacts to all of these developments. The U.S. dollar deserves equal attention. Because silver trades globally and dollars' currency movements can significantly influence prices. A weaker dollar generally makes silver more affordable for international buyers. A stronger dollar often creates temporary pressure. If future economic conditions weaken the dollar while industrial demand remains strong, silver could receive support from both directions at the same time. Professional investors understand these relationships. They rarely focus on one headline. Instead, they study how multiple trends interact. Right now, many of those trends appear to be moving toward the same conclusion. Demand continues expanding. Supply remains constrained. Economic uncertainty persists. Central banks continue accumulating hard assets. Technology keeps increasing silver consumption. These are not isolated events. They represent a much larger picture. Perhaps the most overlooked part of David Morgan's warning involves silver mining companies. Historically, silver miners have often outperformed physical silver during powerful bull markets. If silver prices begin rising faster than mining costs, profit margins can expand dramatically. That possibility attracts institutional investors looking for leverage to rising precious metals prices. Mining shares remain volatile. They carry operational risks, political risks, environmental risks, and management risks. However, when silver enters a sustained bull market, many mining companies historically experience much larger percentage gains than the metal itself. This relationship explains why professional investors monitor mining stocks so closely whenever silver fundamentals begin improving. At the same time, not every mining company benefits equally. Low-cost producers with strong balance sheets, diversified operations, and growing reserves often attract the greatest investor interest. Exploration companies may also perform well during optimistic periods, although they generally involve higher risk. Understanding these differences becomes increasingly important if the silver market enters a new phase. The key message emerging today is not that silver will suddenly explode tomorrow. Markets rarely move in straight lines. Corrections remain normal. Volatility remains inevitable. But the foundation supporting silver appears stronger than it has been for many years. That is exactly why experienced investors are beginning to pay closer attention. One of the biggest reasons this story deserves attention is because silver has a long history of surprising the market when sentiment finally changes. For years, silver can trade inside a relatively narrow range. Investors lose interest, trading volumes slow, financial media focuses on other assets. Then suddenly, conditions change, investment demand accelerates. Industrial buyers compete for available supply. Momentum traders enter the market. Mining shares begin outperforming. The move feeds on itself. History shows this has happened before. No one knows exactly when the next major rally could begin, but the ingredients that fueled previous advances appear to be developing once again. David Morgan has repeatedly explained that the silver market is much smaller than most investors realize. Compared with global stock markets or government bond markets, the total value of investable silver is tiny. That means even a relatively small shift in institutional capital can create a large impact on price. Imagine billions of dollars searching for physical silver in a market where available supply is already tight. Prices do not need unlimited demand to move higher. They simply need demand that exceeds available supply. That is why silver can remain quiet for years before making dramatic moves. Another important issue involves above-ground inventories. Many people assume there is unlimited silver waiting inside vaults. The reality is much more complicated. Some silver is held by investors. Some is owned by exchange-traded funds. Some supports industrial manufacturing. Some is held for strategic purposes. Not every ounce is available for immediate sale. If industrial users begin competing directly with investors, available inventories can shrink much faster than expected. This possibility becomes even more important during periods of economic uncertainty. When confidence in financial markets declines, investors often increase allocations to hard assets. Gold usually benefits first. Silver often follows. Because silver has a smaller market size, it sometimes reacts with much greater percentage gains. The gold-to-silver ratio also deserves attention. This ratio measures how many ounces of silver equal 1 ounce of gold. Historically, the ratio has moved through wide cycles. When the ratio reaches unusually high levels, many analysts believe silver may be undervalued relative to gold. As the ratio falls, silver often outperforms. Many experienced precious metals investors watch this relationship closely because it provides valuable clues about market sentiment. Another trend attracting attention is the continued expansion of renewable energy infrastructure. Solar panels require significant amounts of silver. Governments around the world continue supporting clean energy investment. Private companies continue building manufacturing facilities. Electric grids continue expanding. Every major renewable energy project increases long-term demand for industrial metals. Silver remains one of the most important. Artificial intelligence is adding another unexpected layer to this story. The race to build more powerful data centers requires advanced electronics. Those electronics depend on highly conductive materials. Silver offers unmatched electrical conductivity. As technology companies invest hundreds of billions of dollars into computing infrastructure, industrial demand continues strengthening. Many investors focus only on artificial intelligence software. They often overlook the physical materials needed to support that technology. Silver sits near the center of that supply chain. Geopolitical uncertainty creates another powerful influence. Global trade tensions remain elevated. Supply chains continue adapting. Strategic resources receive greater government attention. Countries increasingly recognize the importance of securing reliable access to critical minerals. Silver has become part of that discussion because of its importance across multiple industries. When governments begin viewing a metal as strategically important, market dynamics can change significantly. Mining companies also face rising challenges. Production costs have increased. Energy expenses remain elevated. Labor costs continue climbing. Environmental regulations have become more complex. Developing a new mine requires enormous investment. Even if silver prices rise sharply, additional production cannot appear overnight. This slow response creates conditions where demand may outpace supply for an extended period. Investors sometimes underestimate how long commodity shortages can last. Once inventories begin tightening, markets often require years to restore balance. That process can support higher prices over long periods rather than only brief rallies. Another factor supporting long-term optimism involves investor psychology. Many people entered precious metals during periods of crisis. When markets stabilized, they left. Today, interest remains relatively modest compared with previous precious metals bull markets. That means silver does not require existing investors to buy dramatically more. It only requires new participants entering the market. If institutional investors, pension funds, wealth managers, and retail investors all begin increasing allocations simultaneously, demand could accelerate rapidly. David Morgan has often emphasized patience. Successful investing rarely depends on predicting the exact day a market turns. Instead, it depends on recognizing major trends before they become obvious to everyone else. That philosophy explains why experienced investors spend so much time studying supply-demand, production costs, and macroeconomic conditions. They understand headlines change every day. Fundamentals usually change much more slowly. Today, those fundamentals appear increasingly favorable for silver. Does this guarantee a straight move higher? Of course not. Markets remain unpredictable. Unexpected economic strength could temporarily support the dollar. Higher real interest rates could create short-term pressure. Industrial demand may fluctuate with global manufacturing activity. Short-term volatility will always exist, but many analysts argue that long-term structural forces appear stronger than temporary market swings. Silver miners deserve another close look in this environment. During early stages of precious metals rallies, investors often prefer physical bullion. As confidence grows, attention shifts toward mining companies. Higher silver prices improve revenue potential. Existing operations become more profitable. Previously uneconomic projects become financially attractive. Exploration activity increases. Capital flows into the mining sector. Historically, this sequence has repeated itself during several commodity cycles. Not every company succeeds. Operational execution remains essential. Political stability matters. Reserve quality matters. Management experience matters. Investors who understand these factors often separate stronger companies from weaker ones before the broader market notices. Perhaps the biggest takeaway from David Morgan's warning is that silver may no longer be driven by only one story. This is no longer simply about inflation. It is no longer only about central banks. It is no longer only about safe haven investing. It is the combination of industrial demand, technological transformation, limited mine supply, growing investment interest, and macroeconomic uncertainty all moving together. When several powerful trends align, markets sometimes experience changes that surprise almost everyone. That possibility explains why so many experienced precious metals investors believe the next chapter for silver could look very different from the last one. The final piece of this story is perhaps the most important because it focuses on what investors should actually watch over the coming months instead of reacting to every headline. The first signal is physical demand. If bullion dealers begin reporting stronger buying activity while available inventory becomes harder to source, that could indicate growing pressure beneath the surface. The second signal is industrial demand. Watch updates from solar manufacturers, electric vehicle companies, electronics producers, and technology firms. If those industries continue expanding, silver consumption may remain stronger than many current forecasts. The third signal is monetary policy. Every Federal Reserve meeting matters because interest rate expectations influence both the US dollar and precious metals. If inflation remains stubborn while economic growth slows, investors may begin expecting easier monetary policy in the future. That environment has historically supported both gold and silver. The fourth signal is the US dollar itself. A strong dollar often creates temporary pressure on metals. A weaker dollar usually provides support. Currency markets move quickly, but long-term trends often influence precious metals for extended periods. The fifth signal involves global central banks. While central banks primarily buy gold, their actions reveal how governments view financial risk. Continued accumulation of precious metals reflects growing concern about long-term monetary stability. That sentiment often spills over into silver as private investors seek similar protection. The sixth signal is mine production. If annual supply growth remains limited while demand continues rising, the market imbalance becomes increasingly difficult to ignore. That is exactly the type of environment David Morgan believes deserves close attention. One interesting aspect of today's market is that many investors remain skeptical. Some remember previous rallies that faded. Others believe technology will eventually reduce silver demand. Some assume new discoveries will quickly solve supply shortages. Healthy skepticism is normal. Markets need both buyers and sellers. But successful investing often requires looking beyond current emotions and focusing on measurable trends. When production struggles to expand while demand keeps growing, those numbers deserve attention regardless of daily market sentiment. Another important point involves volatility. Silver has always been one of the most volatile major commodities. Sharp rallies are often followed by sharp pullbacks. That volatility can frustrate short-term traders. Long-term investors, however, often view corrections differently. They recognize that major bull markets rarely move in a straight line. Instead, they advance through a series of higher highs and higher lows while testing investor confidence along the way. Patience has historically rewarded those willing to focus on the bigger picture rather than daily price swings. Mining companies may experience even greater volatility. Their shares often rise faster than silver during strong bull markets. They can also fall much faster during corrections. That is why experienced investors carefully evaluate management quality, production costs, financial strength, reserve growth, and political risk before investing in any mining company. Not every miner benefits equally from higher silver prices. Selection matters. Diversification matters. Risk management matters. As we look ahead, several possible scenarios could unfold. If global growth remains stable while industrial demand continues expanding, silver could gradually move higher through stronger manufacturing consumption. If economic conditions weaken but central banks respond with easier monetary policy, investment demand could become the primary driver. If geopolitical uncertainty increases, safe haven buying could accelerate for both gold and silver at the same time. And if several of these forces develop together, the upside potential becomes much more significant. No one can predict the exact timing. No analyst can guarantee future prices. Markets will always surprise both bulls and bears, but ignoring structural changes has often proven more expensive than paying attention early. That is why David Morgan believes the discussion should move beyond daily headlines and focus instead on long-term fundamentals. Silver is no longer simply another commodity. It has become an essential industrial metal. It remains a monetary metal. It serves as an investment asset. It supports renewable energy. It powers advanced electronics. It plays a growing role in artificial intelligence infrastructure. Very few commodities occupy all of those positions at the same time. That combination makes silver one of the most fascinating markets to watch over the coming years. Whether price suppression truly ends now remains a topic of debate. What matters more is whether supply and demand continue moving toward imbalance. If that trend continues, market forces rather than opinions will ultimately determine where prices go next. The coming months could reveal whether this is simply another temporary rally or the beginning of a much larger cycle that changes how investors view silver forever. That is why experienced investors are watching inventory levels, mining production, industrial demand, Federal Reserve policy, inflation trends, and global economic data more closely than ever before. The story is becoming bigger than one headline. It is becoming bigger than one analyst. It is becoming bigger than one market event. It is becoming a story about how the world is changing and how one metal sits at the center of those changes. Whether you already own silver or you are only beginning to follow this market now is the time to stay informed and understand the forces shaping the next chapter. The biggest opportunities often appear before the majority recognizes what is happening. David Morgan believes that moment may be approaching. Only time will reveal whether this becomes one of the biggest silver bull markets in modern history. If you enjoyed this analysis, make sure you like this video, subscribe to Silver and Gold Watch, and turn on notifications so you never miss our latest updates on gold, silver, inflation, the Federal Reserve, global markets, and the biggest investment stories shaping the future. Thank you for watching, and I will see you in the next video.